So hello guys, in this video I will talk about the whole concept of banking. Okay, so a lot of people who are not interested in financial knowledge or they don't know how a bank works, this video is for you because I know it can sound a bit fishy, but it's very important for you, irrespective of your field in whatever you're doing. I don't know, but you have to understand how a banking system works because through that you will understand how the economy works. So banks are like the intermediaries. Okay, they if you understand the whole financial system, a whole financial system comprises of households like we, individual households are there. We have the intermediaries like the banks and the financial institutions, okay, or the financial markets. I'm extremely sorry. What happens that every time you see every now and then that companies, big companies who are running, they need money to operate, okay, and for that reason they raise funds, and they can raise funds through any medium. They can take the help of equity financing or debt financing, it doesn't matter, but they need funds because they need excess amount of funds, they require that funds. Okay, there is a deficit in the funds. So now people who have surplus money, like the households, these households people, what they do is that they take the surplus money, keep it in the bank, or you go and invest in stock market. And what happens is that indirectly you are giving money to the businesses. Why you are giving them to actually those businesses? They are the one who are actually running the economy for you, and they are running the economy. And what this intermediaries does that, or banks and the financial markets, they allocate these resources in a very in productive and useful sectors. Okay, of course you want your money to go into the most productive sectors. So here what bank does or any financial market does, or the capital market, let's say. So in this case, I will talk about the role of banks in an economy. Why you have to understand the role of banks. Number one, you deposit some money and bank takes it. Okay, and now you have a thought, let's say, how the credit creation goes on, means how they multiply this initial deposit into, let's say, 5 times more. How they do that? So if you think about that very carefully, you understand that. If you have read economics, you know that it's known as money creation by commercial banks. So this is basically done by the commercial banks, and they are what they do is that they take a part of the deposit, let's say 10%, and now this 10% is what is known as LRR, legal reserve ratio. It is the amount of money that a bank, a commercial bank, is legally obliged to keep keep aside, okay, for security reasons or for reasons which I will discuss later in this video. So now you see, you get, suppose someone deposited 100 rupees and the bank received 100 rupees. Okay, now 10% it will side aside, that means that is 10 rupees. So total I have 90 rupees. Now the 90 rupees will be given as credit, not the full 100 rupees. And the reason is very simple, because to handle the demand of withdrawal of demand, okay, like it may happen that people may withdraw, okay, money. Now it doesn't happen that every one of the customers are coming at the same day to withdraw their money. It doesn't happen. So to keep a security, they take some portion of the money and they keep aside, let's say 10%, 20%. And this percentage is actually set by the RBI, or the central bank of any country. Okay, for US it is Federal Reserve, for UK, means for Britain, it is Bank of England. Now the thing is that like this the credit creation takes place. Okay, and again you give loan to someone, that person takes a loan, okay, use some of it. earns profit, deposit that thing. Okay. Now he gets the credit and deposit. Again, this cycle continues, but it has an end. The end is that when we'll see that the total, okay, the total of the legal reserve ratio is equal to the initial deposit. At that time, you will understand that this credit creation process is over. But it doesn't happen in a real economy, because economy is always creating credit. Okay, it never stops. But for simplicity's sake, I'm just telling it that for quotient practices, it is like what you have to understand. Okay. Now the thing is that a very important thing that a lot of people misunderstand is how a bank earns money. Okay. And basically, you see, bank doesn't earn money from deposits. Okay. A lot of people have misconception about it. Banks make money through lending, and it is what the banks does. You may get phone calls, okay, like, sir, do you need credit, a loan, let's say, okay, then you reject that. Banks knows that if I keep my deposits idle, inflation will eat away that money and it will be of no use, so I have to lend to someone who needs it. Okay, so bank earns when it lends. Let's say the deposit, you will always see in any bank, the saving account, you will see that deposit, the rate of deposit is, let's say, 3%, 2%, okay, but the lending rate is more, let's say 6%, 7%, 8%. So the difference between the lending rate and the depositing rate becomes the bank's income. Okay, this is how a bank earns money. Now the most important thing, again, another thing is that banks, the commercial banks, they are known for credit creation. Okay, now let's talk about these central banks of the country, and they act as a regulator, facilitator, and what they does that they supervise the commercial banks. Now there are a lot of functions. Of course, they act as a banker to the government. These dogs are barking, I don't know why. It acts as a banker to the government. Central bank also controls the overall money supply in an economy. Okay, it's very important function of central banks, and all these functions of central banks are actually differentiated or divided into qualitative and quantitative methods. Okay, so let's talk about quantitative first. Okay, you have heard about the term repo rate, reverse repo rate, bank rate. Okay, OMO means open market operations. You've heard about all these things. So what is the meaning of that? What happens if you decrease repo rate or increase repo rate? What happens? See, basically, what is repo rate? Okay, repo rate is the rate at which the central banks lends money to the commercial bank to meet their short-term needs. Okay, to meet their short-term needs. That means the commercial bank is actually lending money. Sorry, the central banks are actually lending money to the commercial banks. Okay. Now, bank rate is similar, but it is given for long period of needs or for long-term needs. Okay. So what will happen if we increase or decrease the bank rate or the repo rate? What will happen actually? A very easy thing. See, if you increase the repo rate or the bank rate, let's say, what will happen? First of all, the rate will increase. That means the commercial bank, the cost of borrowings of the commercial banks will increase. Okay, that means previously, let's say, bank were taking loan from let's say the central bank at 6%. Now let's say it has been increased to 7%. Now to give more interest, so the cost of borrowings for the commercial banks will increase. Okay, as the cost of borrowing will increase, the lending rates of the commercial banks will also increase. Why? To compensate their losses. Okay, you're giving more, you need to earn more, right? That's the reason you are increasing your lending rates. So as you will increase your lending rates, there will be discouragement of loan taking. People will not take loan from you because the lending rates is more. So we will not take loans from you. And as people will not take loans from you, the credit creating power will decrease. Because the whole bank, my dear friend, the whole bank actually works on two principles: deposit and lending. You accept the deposits and you lend the money. You do both the things. Any bank, sometimes we hear that banks are collapsing, they're getting bankrupt. Why it happens? Because there should be a balance between deposit and lending. Let's say a bank is getting deposits, a lot of deposits, but no one is lending from them. So what they will do? They have a lot of options, by the way, because they can use that money, that deposit, and keep it with the central banks that we learn in the reverse repo rate. But if you see, fundamentally, no one is taking loan from you. People are depositing money, but no one is actually taking loan from you. First of all, how will you make money? Because you're not lending, right? Second, how will you give money to your depositors? Number two. And what is the function of you? Okay, you are a bank and you don't lend money, then you are a storehouse. Okay, you're just storing the money. You're not doing anything with that money, you're just storing that money. On the other hand, let's say a bank is lending, but the depositors are not depositing. It also happens. That's the reason you will see that in banks, you go to banks, you will see that they have a minimum limit. Like, you have to keep 2,000 rupees in your bank. You can't withdraw that. That is the reason, because you need a deposit. Without deposit, if you don't deposit, how will you lend it? If my depositors are less, how can I lend the money? And if my depositors are more and there's no lenders, how can I lend the money? The whole business model of a bank works on lending. So if you can't lend as a bank, then you are a failure. That understand. That's the reason both lending and depositing is equally important. Both are interconnected. If you don't deposit, banks will not lend. And if you don't take lendings, what banks will do? Okay, this is how some of the major banks in our world, it gets collapsed. Okay, the next thing is about what will happen. Okay, let's talk about that. So it will decrease the credit creating power, and thus it will also decrease the money supply in an economy. So it is basically done when there is inflation. Okay, when the aggregate demand is more in the market. This is what government does. Okay, they increase the repo rate. Okay, now similar thing happens if you decrease the repo rate, okay, or the bank rate. First, cost of borrowings will become less. Of course, if you decrease the repo rate, it will become less. Lending rates will become less, okay, of the commercial banks. People will take more loans. More loans will encourage the bank to create more credit, and more credit will actually pump money in the economy, and the money supply will increase. Okay, so what is reverse repo rate? So reverse repo rate is a rate at which commercial banks keep their surplus funds with the central banks, generally for a short period of time. So sometimes it happens, like it happened during the COVID times. All the people were depositing money, but no one was lending money, because COVID was a time, it was a pandemic. A lot of businesses, it went bankrupt, and you know that what happened at that time. Okay, and lending power was less. So at that time, what they did, that they kept that money or some part of the money with the central bank, and they earned reverse repo rate interest through that. It's also an earning for the commercial banks. Now this is how reverse repo rate and bank rate works. What is open market operations? So open market operations is sometimes what happens that it is known as the buying and selling of government securities by the central banks to and from the commercial or from the public banks. Okay, so basically what happens, a government has a lot of treasuries, okay, a lot of securities, and it is the RBI who has a power to buy and sell those securities and those kind of bills in the open market. Okay, so when a commercial bank, so when a central bank purchase, that means what, when you're purchasing, you're giving money to the central banks, sorry, to the commercial banks. Okay, and the commercial banks are giving those securities to you. So what you're doing is that you are increasing their amount, that their cash reserves is increasing. Commercial banks cash reserve is increasing, and thus it is increasing their credit creating power, and thus it is also encouraging money supply. Money supply is increasing, and it actually happens the opposite when we talk about selling of securities. Now again, another thing is that there's qualitative methods like model suasion, credit control instruments, and another thing is that margin requirements. Okay, so the margin requirements is what? It's the difference between the loan amount and the value of the collateral. Okay, sometimes it happens that, let's say you take a loan of 1 lakh rupees from a bank, and bank asks you to give some collateral as a security. Now let's say they told you that give us collaterals of worth rupees 50,000. If you see, the margin requirement is 50,000. That means 50% is the margin requirement. Not a single person will take loan from that bank because the margin requirement is more. So of course, lending capacity will decrease, credit creating power will decrease, and money supply in the economy will decrease. And this margin requirements is set by the RBI. More the margin requirement, less will be the ability of the commercial banks to create credit. Okay, and if less it is, you know what is the answer. Model suasion is, is creating pressure on the commercial banks. It is done by the RBI. Okay, it is persuading them, persuasions, manipulations, maybe forcing them act in this way. Okay, like this is our policies, act in this ways. If you can't, although there is no legal things, like if commercial banks don't listen to these RBI can't do anything. Another thing is they do is that credit controls. Okay, now RBI has a power to see which sectors of the economy have to be given more importance and less importance. Now, you go to a bank and you see that a bank offers a lot of loans like car loan, house loan, whatever loan you can say, education loan, okay, business loans, etc. See, for any economy, education is very important, then homes, or then cars. So RBI will say that, you know what, you decrease the rate of interest on the education loan. People should get education, it is a fundamental right. So you should decrease the rate of interest on education so that people can take cheap credit from it. On the other hand, you can increase your credit rate of interest on car loans or house loans. Okay, so this is how RBI makes sure that money is going to the most important sectors of an economy. So this is how the money is all about, and this is all about the kind of banking stuff. Okay, in the next video I will talk about more about banking. So if you really love this video, then please give a like and comment down below what you want to see next. Although this video is a very long video, it's almost 20 minutes, so I hope you people are have gained some knowledge. Okay, actually it's for my revision. I have economics test. Okay, so I have to give test, so that's the reason I'm making this video. So tell me if I'm wrong or right, and give your opinions, right? That's all, and we will meet in the next video. On the other hand, okay, one thing, how banks, okay, in the next video we'll talk about more, we will talk more about banks. Okay, and the next video will be very important. So please stay tuned. Thank you.